And what if we want to find out the margin safety percentage, right? So be vigilant when the question asks, whether the question is asking margin of safety, just margin of safety, which is budgeted sales or actual sales minus the break-even sales. And now the percentage. If you want to find out the percentage would be margin of safety divided by sales, which means margin of safety divided by sales. And this sales is actual or budgeted one. So here we know that the difference is here. The difference is 50,000, and what is our actual sales here? 250,000. So our answer is 20%, right? So most students, they confuse that in our denominator this is break-even sale or the actual or budgeted sale. So here the answer is, you have to write down here actual or estimated or budgeted sales. Okay, good. So like I said in our previous slides, that we can also find out how much the margin of safety in units. So we know that the budgeted units are 500 and break-even units are 400. 100 is our margin of safety in units. You can also find out with different formula that we know that the margin of safety is 250,000 minus 200,000. Answer is 50,000, and you divided the actual or budgeted sales price per unit, which is 500. Answer is the same. You can use either of the formula. So here comes again the quick check, the same question. So I want you to pause the video and solve it by yourself. So okay, what we have to find out here, we have to find out the margin of safety expressed in terms of units, which is cups. So what is our sales right now? 2100, and we have to less it with break-even units, right? And what was the break-even units we calculated in our previous slides? So I cannot see the previous slide, so I'm just gonna solve it here. So we know that break-even in units will be equals to profit, which is 0, plus fixed cost divided by CM in units. So fixed cost is 1300 and CM units is 1.13. Answer is 1150. So here it is. When you write down, we know that 1150 is our break even in quantity in units. So what is margin of safety? Margin of safety in units, the actual or budgeted sales, which is 2100, and what is the break-even sales? 1150. When you less it, answer would be 950. So answer B is correct, right? And now the cost structure and the profit stability. So a company's cost structure refers to the relative proportion of fixed and variable cost in an organization. So recall our discussion regarding the fixed cost analysis over there, which we talk about that changes in a fixed cost affect greater the profitability. So the companies like utility companies, so they have heavy investment in property, plant and equipment. So many utility companies, they have high proportion of fixed cost and they cannot change it drastically. So right, so in other companies, managers often have some kind of latitude in determining their organization's cost structure. They can decrease their variable cost to check the profitability, they can decrease their fixed cost to check the profitability, or they can choose either of the mixing of this fixed and variable cost. And for the more complex situation, they can also change the sale price and number of units sold as well. So let's move further to explore this. So there are some advantages and disadvantages to high cost or low variable or low fixed cost, which means high variable cost structure. So generally, companies with high fixed cost structure will show higher net income in good years than companies with lower fixed cost structure. Right here. So a disadvantage of high fixed cost structure is that income will be lower in bad years. Why? Because there's a huge fixed cost and your sales are low, your variable cost will be lower as well, so your contribution margin will be lower and your fixed cost will be high. You will be getting definitely a loss situation or low income in bad years. Okay, so companies with low fixed cost enjoy greater stability in income across good and bad years. So that is that tidbit here. Remember, low fixed cost is preferred situation for any kind of business. But if you cannot control the fixed cost, then be prepared about the disadvantage of fixed cost, that in bad years you're going to be having a low profit or loss situation. So here I have pasted question 6.12, which is target profit break-even analysis, margin of safety, contribution margin ratio. So I just want you to pause the video here and try to solve this question, and I'm going to be uploading its solution to the WeChat group and our Blackboard discussion as well. So you can consult your verification of your answers from there. So just pause the video and try to solve it right now, because this is a continuous discussion we are having here. So you can just further strengthen your concepts. Okay, I'm just going to move forward. It's the same question, part 4 and 5, and also do that, pause the screen and try to do it by yourself, and at the end compare your answers to the answer picture that I would be sending in your WeChat group and Blackboard.